All right, our next guest says the brunt of the recession will be over by year's end, and certain ETFs will lead the way out of the recovery. Or into the recovery. Rob Stein, managing partner with Astor Asset Management. Rob, good morning. Thanks for being with us.
Thanks for having me.
Oh, also author of The Bull Inside the Bear, Finding New Investment Opportunities in Today's Fast-Changing Financial Markets. Bob Pisani joins us as well. Robert Stein.
Hi.
Why are you so confident the economy is going to be turning around so quickly?
Well, a couple of things. Consumer spending, which is 70% of GDP, has fallen off a cliff. It's fallen to levels from a 1950s economy, and that's unsustainable, even with the unemployment rate going up.
What's unsustainable?
The amount of consumer spending that's declined in the last few months compared to the unemployment rate. We're spending as if unemployment is closer to 30%.
Well, aren't we also spending as if we can't get any new credit cards and can't get any more home equity loans to fund our insatiable need for useless crap?
Yes, there's a portion of the economy that fits that mold, but there's a portion of the economy that's actually working, 135 million people to be exact, and they're making money, and they do have the credit available. They do have their credit cards that are working, and they've contracted spending as well. I'm not suggesting that we go to the spending days of a 4.5% unemployment rate, but the consumer spending right now is not related to where we are in the unemployment rate, and that's not sustainable, and that's going to help pull us out of this recession sooner than you think.
Bob Pisani is somebody who spends a lot of money on not useless things, on useful things. Yes,
Thank
you know,
I have a vast
bizarre
treasure trove of
gelato
useful
makers
crap.
and things like that. He does his part.
If you don't, I'm sure your wife does.
Thank you.
Rob Stein, I want to give a chance to Bob a chance to react to your ETF calls. So, if one buys your more optimistic view, what are the ETFs you buy now?
I like the XRT, which is the retail sector, because as I mentioned, consumer spending I think is going to pick up, and that'll be the sector that'll benefit from that. In fact, the XRT is even up on the year, which is sort of counterintuitive coming into a recession that seems to be deepening. I also like China for the obvious reasons. Their stimulus package is bigger than ours, and I don't think their problems are quite as severe as ours, so you can buy the FXI, and that too is up on the year. And as your guests earlier in the show said, I like technology, specifically the semiconductors. Technology companies adapt quicker to economic slowdowns. So as you get into the trough of an economic slowdown, they're not suffering as much. And when you start to pull out of it, the technology stocks tend to lead the way. And again, the semiconductors, the SMH, and even the QQQs are about flat to slightly up on the year.
Hey, Rob, it's Bob Pisani. I agree. The interest right now is in commodity funds as well as emerging market funds. China's getting some interest again. Here's my question. Is this finally going to be the year of ETFs? I've been covering ETFs for 5 years now. I'm a big backer of them, but they're still maybe $400–500 billion. Mutual funds, $4 trillion. It's a fraction of the mutual fund market. When are the low costs of ETFs? When are the fund managers, when are the money managers finally going to realize that this is a better value proposition for a lot of their clients?
Yeah, you're preaching to the choir. We exclusively use ETFs at our firm to manage client portfolios, and our mantra is ETFs can save your life. There's always an ETF that's going up somewhere, whether it's an inverse one, and it also gives you total non-correlation. As you mentioned, you can buy the GLD, which is gold, you can buy treasuries, you can buy inverse treasuries. They're wonderful products for creating asset allocation and pure exposure. And I think the wave is coming. If you see the growth, while it's still dwarfed by mutual funds, Bob, but the growth year over year is significantly larger in the ETF space.
But what I'm hopeful is that the fund managers are finally going to get more value-oriented. They've been collecting nice fat fees for a lot of these mutual funds for years. ETFs may not have the fat fee structure, but we've got to figure out a way to get them into the 401ks, which is where the real money is at this point.
You know, we talk about that every week. We're writing letters to get on the platforms. Our firm's on a handful of platforms, and we keep lobbying to get more ETFs on them. But you're going to start to see interesting things in the ETF space. Actively managed ETFs. You're also able to put them in a wrap account so you can charge a fee for selecting them. There's a variety of things that are occurring. It's a very innovative market. In fact, I think the ETF is perhaps the greatest financial created instrument since the put option. So we're big fans of ETFs. In fact, you're able to survive this economic calamity by selecting a nice diversified portfolio of ETFs.
And Vanguard is raking in the cash because they very appropriately for their business, went out and started huge ETF funds a couple of years ago. Fidelity did not.
Oh.
Right.
Okay.
Thanks to both of you.
Thank you, gentlemen.
Thanks, guys.
And next, our investor.